Hello, Marc from ADM Investor Services International, with some thoughts this week on the slight bout of risk aversion that we seem to be having, and looking at it specifically in the context of emerging markets. But starting off in the most obvious place with a chart which is all too familiar. I've posted this one many a time before. It is the US high yield credit average spread versus the S&P 500 index. And as one can see, they are doing a good job of mirroring each other. But perhaps interestingly, and there is a good reason for this, which I'll come to in a moment, it is clearly the case that for a change, the S&P 500 is actually leading the high yield credit spread, which typically doesn't happen. It's normally the other way around. And I think this is mainly for the reason that the sell-off that we've seen has been primarily driven by the tech sector. And within the tech sector, there are a number of companies which actually borrow quite a lot, but they're not high yield. And there's not many companies which do in the tech sector in the high yield bond market, hence the lack of responsiveness initially. It's a very energy heavy index. Moving on. So how does this pan out in terms of what we're seeing in emerging markets? Because there is clearly a broader risk aversion going on here. My second chart for today is the JP Morgan Emerging Market Bond Index. Hardly a massive spike wider here, but we have started to drift wider, having crunched back in after spiking wider back in March. I think the hunt for yield is still definitely on, and that's capping things. But there are clearly pressures starting to emerge. And this is all the more noticeable when we come to my third chart, which is the JP Morgan Emerging FX Currency Index, which, as one can see, we had recovered quite sharply. We've gotten to nowhere near the sort of levels of risk appetite that appeared to be the case at the beginning of the year. And that's understandable. We've got a lot of emerging market central banks doing QE, cutting rates to extraordinarily low levels. We've got rates down at 2% in Brazil. And in a lot of countries, other countries, they may be even as low as 0.25 or 0.5%. So the attractiveness of charging into emerging market currencies only works when the dollar is weak, as it was for the summer period. Which brings me to the two other charts for the day, boring down into a couple of an example of a strong currency and an example of a weak currency. Let's start with a weak currency. And the obvious one is obviously the Turkish Lira. That has been under a huge amount of pressure. And even with the 200 basis point rate hike that we had this week, somewhat post hoc, one would say, and only due to the fact that Turkish FX reserves have been run down so much, that there had to be some sort of give within interest rates, but that has hardly given a lot of support, as one can see from this chart, to the Turkish Lira. By contrast, obviously, we have the Chinese Yuan. And on that front, obviously, we've had a lot of strength in the yuan, which has made a lot of sense because it is the economy which is within the global recovery context, which is showing decent signs of recovery. But even this has given back some of the ground it made against the dollar. Very modest, I would suggest. When one looks at it, as the dollar has started to strengthen again. I think the dollar strength that we're seeing is a timely reminder that while we may be disappointed by the lack of fiscal stimulus, which may now not, a fiscal package may not appear until after the election, that the dollar is the world's funding currency, and you can't actually always just short the dollar for a long period of time. So those are the thoughts for this week. We are definitely in a risk-off scenario, and I suspect there's going to be more trouble to come.